We're absolutely honored to have Bill Nygren here with us today. Bill Nygren is the portfolio manager of the Oakmark Fund, the Oakmark Select Fund, and the Oakmark Global Select Fund. He's also the Chief Investment Officer for U.S. Equities at Harris Associates and the Vice President of Oakmark Funds. Bill Nygren has received many honors during his highly successful investment career, including being named Morningstar's Domestic Stock Manager of the Year for 2001. His appearances on CNBC and quarterly market commentary letters are phenomenal resources for any value investor.
Thank you so much for such a kind introduction, Itai.
Thank you. Thank you for being here today. So, Mr. Nygren, could you please begin by telling us a little bit about Harris Associates and its background?
Harris Associates got its start in the investment business probably 50-ish years ago. And it was primarily what we call now a high net worth advisory firm. Back then, people would come to us with the majority of the money that they wanted invested in equities and say, here it is, take care of it. We're wealthy already. We don't ever want to be not wealthy. So a conservative business approach, conservative investing approach made sense with their money. The founders of the firm all kind of coalesced around a long-term value investment style. And that was in place at Harris when I joined in the early 1980s. And basically, I would say there are a few ways that we could talk about what we do. Kind of traditional value investing. One thing that I like to say is I think we bring a private equity perspective to public equity investing. But it's good long-term value investing. So when we look at a company, we expect we're going to be invested for 5 to 7 years. We think about business value based on what we think the company will be worth 5 to 7 years from now, and then discount it back. We don't want to pay more than 2/3 of current present value. We want the business to be growing at least as fast as the average business, and we want management to be aligned with us. When all those three things are in place, then we're comfortable that we can take this really long-term time horizon and expect the gap between business value and stock market price to close.
So people were wondering, you had a lot of commentary in the past on some of the FANG stocks, and they were wondering what stocks, if you rank them today, the FANG stocks and Microsoft as well, how would you rank them based on their durability of their moats?
So we're a little bit unusual in value investors in that we have owned most of the FANG stocks and Microsoft. Most value managers you'll hear when they talk about how crazy valuations are today, they'll reference the FANGs as being crazy. We don't think the FANGs are crazy at all. We currently don't own Amazon, but we wouldn't argue it's grossly overvalued. It's just hard for us to get comfortable with AWS. We did own Amazon for a while, a few years ago. It feels like a long time ago in stock price because I think we were buying it in the mid 200s, and everybody thought we were heroes when we held it from mid 200s to 400, and then we moved on from it after that. But the reason we owned it back then was it was selling at a lower price to sales ratio than the bricks and mortar stores it was putting out of business. And we thought that was a silly valuation, that Amazon, instead of maximizing current profitability, was instead investing through the income statement for supernormal growth in the retail industry. So while other retailers are growing 2 or 3% a year, they were able to grow at 25% a year. But the cost of that was not reporting profits. So as we looked as value investors, the big question we had to answer was that a logical investment? Would you give up a year's profit to grow 20 percentage points faster than your competitors? And that was pretty easy to look at the numbers and say, yes, that made tremendous sense. Then the question was, what would Amazon have to do to prices to make their margins similar to other retailers? And we said they would have to raise prices about 700 basis points to catch up with the rest of the retail industry and margins. And if they're growing 25% a year and they lowered prices 7%, so they only grew 18% that year, how much of Amazon's business would leave because of a 7% price increase? And in looking at surveys of customers, in doing some of our own work with customers, we concluded that they would not lose much business if they raised prices 7%. So we got comfortable that as a retailer, Amazon was cheaper than the rest of the retail industry. What happened, sort of unfortunately for us, was how quickly AWS emerged as a very important and profitable business. At the time we owned Amazon, it was this expense that was running through the income statement that it was kind of like venture capital spending. You almost wished they weren't doing it, so they were reporting a higher profit instead. And then suddenly it got to where analysts were valuing AWS just as highly as the retail operations. And we were uncomfortable with that. That was kind of out of our wheelhouse. We didn't have a way of thinking about cloud services that would convince us that that was cheap. So, in terms of moat and durability, kind of getting back to your original question, the retail side of Amazon, we were very confident that the moat they were developing, largely through technology and the ability to offer price discounts, was quite durable. But AWS was a business we didn't understand well enough to be comfortable making that same statement. I think if you look at Alphabet, which has been our largest holding for most of the past couple of years, I think it's pretty clear that they have a very, very strong moat. I'm old enough to remember the early days of search on the internet. And, there was a company, digital equipment that owned Alta Vista, which was one of the first search engines. And I remember people thinking back then, how would anyone ever catch up with Alta Vista? But it was a search engine designed by engineers. The front end wasn't very customer friendly. And very quickly, the Google search engine took over and basically destroyed the rest of the competition. If you look at what Google can spend today, or what Alphabet can spend on search today to make sure that they maintain that leadership role, I don't think there's a chance of anybody displacing the Google search engine. So I would rank that at the highest end of durability of the FANGs. Some of their other businesses, kind of like Amazon Web Services, but the market isn't really making us pay much for them right now. I mean, the way we've thought about Alphabet, it misses a lot of value investor screens because it looks like it's selling at something 30 to 40 times earnings. But when you subtract out the non-earning assets, starting with several $100s a share of cash, and then YouTube that they aren't fully monetizing, certainly their venture cap-like investments with Waymo and Alphabet, or maybe it's Google Web Services. I think it's GWS. If you subtract off of Alphabet's current market price an estimated value for all those non-earning assets, and then add back the income statement losses to what they're earning in search, we believe that you get left, that you're paying less than a market multiple for search. And given the tailwind search has and the durability of the franchise, we think that's an incredible bargain. That's why it's our largest position. We also own Facebook, kind of similar story there, where the base has gotten so large, I think it would be hard for anyone to replicate it. And they're making the generational transition by owning both Facebook and Instagram. I think one of the issues you always get with newer businesses is, will kids go onto the same platform that their parents are on? Will they shop in the same stores? Do they want the same brands? And I think with Instagram, Facebook has kind of solved that problem. But it's the same story on a misleading PE, that GAAP accounting doesn't give them much credit for the cash they own, for WhatsApp, for all of their investments in augmented reality, artificial reality. And if you subtract all that out, Facebook isn't selling at a low 20s PE multiple, but the core Facebook and Instagram businesses are selling at a teens multiple, which we think is much too big a discount to the S&P multiple of whatever it is, like 22 or so right now. So that's why Facebook is our second largest holding out of those names. Netflix is also a name that we own. We think, kind of like the Amazon story, that they've understood that it's not worth fully monetizing their business today, and it's much more important to grow the moat. And in their business, the moat is measured by how big an advantage you have in number of subscribers, because your production costs for new films, new movies, new shows, that's a relatively static number. No matter how big the denominator is, you're dividing it across. And we think because Netflix has gotten the early advantage of having something like 150 million subscribers already, it's going to be very hard. The cost to catch up with that is just very, very high, because Netflix can always match what anybody else can pay and then divide it across a larger subscriber base. When we think about Netflix, we don't think of a company selling at 50 times earnings. We think of a company that's selling at about $1,000 a subscriber and charging $12 or so a month for their service. And yet people who subscribe to lots of monthly services will rank Netflix as more in importance to them than services they're paying $15 to $20 a month for. We think if Netflix decided to slow the growth and fully capitalize on how valuable their product is to customers today, they could charge more like $16 to $18 a month, would not lose many subscribers, and they'd be selling at a low teens multiple. Apple is a stock that we owned for a long time. We owned it for more than a decade, sold it last year. For most of the decade that we owned it, Apple was selling at a pretty big discount to the S&P. So all you had to believe was that it was pretty close to an average company, and you could believe it was cheap. And even though the stock went up tenfold while we owned it, the PE never rose during that period because earnings were growing just as fast as the stock price. And it was only last year that the earnings growth rate and the stock price growth rate really separated from each other. And Apple got to the point that it was selling at a significant premium to the market, and you needed to believe it was a substantially better business than the S&P in order to justify owning it. And at the time, given what the market was doing last year, we thought we were presented with much better opportunities of companies that had gotten hit hard because of fears that COVID would keep the economy closed for a long time. It took us a while to get comfortable with Apple's moat, especially because consumer electronics has not been kind to presumed moats in the past. There was always, you'd have the innovators that would come out with really cool new products, and they would all end up going bankrupt as the imitators would make it just a little bit more consumer friendly, a lot cheaper, and the old companies would go out of business. I think to understand Apple's value well, you have to think of it as not just a consumer electronics company, but also a software company. And the reason that we all pay premium prices for our iPhones is not because the hardware is that much better. It's because of the software side of it. It's what the iPhone does for you. It's your history of knowing how to use that product, of having invested in everything in the ecosystem that relies on you staying inside the Apple ecosphere. So we think it's a great business. And if it was at 12 times earnings again, like it was for most of the past decade, we would quickly own it. But at a mid-20s multiple, we think they're better opportunities. And then similar story with Microsoft. That was a name we had owned multiple years ago, like when the stock was in the 80s. There was the management transition going on. And our mistake there was not realizing how much more valuable things like Excel, Word, PowerPoint were going to be when they could sell it as software as a service. And that transition became much more profitable for them than we had imagined at the time. But it was the same kind of story that Microsoft wasn't selling at a premium multiple. If you believed it was an average business, you could justify owning it as a value investor. And then I guess cloud was also a big part of what went on at Microsoft. And as I admitted earlier, we were definitely not on the leading edge of understanding how to interpret cloud value. So unfortunately there too, the stock price got ahead of the value escalation and we sold it thinking we had better opportunities. In hindsight, that sale looks like a mistake, like Amazon did. Apple so far looks like it was a pretty good sale.
Yeah, that makes a lot of sense. Thank you. Let's circle back to Netflix for a second. Are you concerned that companies like Amazon, which recently purchased MGM Studios, or Disney, which has experienced tremendous growth for its Disney Plus platform, although that growth has been stagnating recently, that Netflix might not emerge the streaming platform winner? Additionally, are you concerned that Netflix still has a heavy reliance on other media companies' contents?
Well, I think there's a lot there, and I'm going to start with the words that you used, the winner. And I think that's a mistake that a lot of people make when they look at this industry. They see people moving from their cable companies where they're paying $100 a month for video to streaming, and they think there's going to be, because we saw a winner in cable, albeit regionally, so different regions had different winners, they think there's going to be a winner in streaming. And I think what we're going to see is that the typical streaming subscriber has 3 or 4 services, and they can pay $15 a month for each one and still cut their cable bill in half. So I'm not so worried about, 5 years from now, will Netflix be bigger than Disney or bigger than Amazon? I think Netflix is definitely a winner. I think Disney and Amazon look like they are likely to be among the winners. And then I would cycle back to something else you said, where Netflix is very reliant on content produced by others. I think you need to split that into 2 different groups. There's content that was supplied by others when they didn't really realize that they were selling to somebody that was going to have 125 or 150 million subscribers. And the rate Netflix paid for that was much cheaper than what they'd be able to re-up that same content at today. We think that is decreasing pretty rapidly as a percentage of Netflix content. There is still a lot of content produced by others, but a lot of that they are happy to sell to Netflix because Netflix is the highest bidder because they can divide it across the largest number of subscribers. And I think Netflix will remain the leader in original produced content for a long time. I mean, when people talk about how much money Disney is spending on content, they forget that Disney's monetizing that already. Everything they spend on sports is monetized via the ESPN franchise. Children's programming is already monetized through the Disney Channel, the Disney parks, the Disney videos. So Disney Plus is really a replacement, like a newer technology delivery system for everything they've been doing already. So I don't really view them as like this new disruptor content. It's more like Disney is making the decision that they can bypass some of the intermediaries before, like the cable companies or the video retail stores that used to sell the Disney tapes, and go direct to consumer. I think there'll be more than one direct to consumer winner. But with 150 million subs and growing 20 million subs a year or so, I think Netflix is going to be very difficult to catch as the leader. And don't forget, with Disney Plus, there are a lot of marketing deals that gave people a very strong incentive to be early subscribers to Disney Plus. As you said, subscriber growth is slowing a lot. I think a big part of that is the current subscribers are having to take on the true economics of Disney's monthly subscription. And if they haven't cut the cord from cable, it's like, how much are they really gaining by subscribing to Disney Plus in addition to cable. So I think it makes sense that we're seeing some slowdown in that sub growth as there aren't so many subsidized deals to get the early sub numbers up so high.
Yeah, that makes a lot of sense. Thank you. And you're discussing cable. You own Charter Communications. So what do you see as the future of Charter Communications if there's declining cable users?
I think one of the mistakes a lot of the bears have made on cable companies is not realizing the multiple sources of revenue that the cable companies have. And the idea that if you cut the video cord, you've cut your connection with the cable company. What's happening instead is people who cut the video cord tend to still get their cable from, get their internet access from the cable provider. And now that they're streaming video, maybe to multiple HD screens within the same household, they're realizing that they need to up the speed on their internet access. So the cable companies are trading dollars that they maybe kept 30 cents on the dollar from, with the rest going to the programmers, to internet access speed additions where they're keeping 100% of that. So if you have somebody lose $100 on the video side, that's maybe $30 of profit, but they end up paying $30 more to get faster internet access. That doesn't change the revenue that the cable company gets to keep. And when people go off video to internet access only, the amount it costs to maintain their subscription goes down. There aren't as many truck rolls for quality of service as there are in video. People aren't as confused about how to connect things. Most of the internet access is done by the consumer by themselves. So we look at Charter and Comcast as basically internet providers that have not entirely completed the transition from video provider, but we don't even see that transition as being a costly transition for them. We think of their role as internet provider as being more comparable to what we see with infrastructure companies. And infrastructure companies tend to sell at much higher multiples of cash flow than the cable companies are selling for today. These companies generate a lot of excess cash. They're comfortable running a moderately high level of leverage on their business because it is such sustainable business. They're all oriented toward share repurchase as being a perfectly fine use of that excess capital they're generating. So most of them still have net income growth. They have EPS growth that's substantially higher than what the net income growth is, because the leverage is declining as the business grows and the share base is decreasing. So those are businesses we like a lot, even though we're no more positive on the future of video delivered via cable than anybody else is.
Yeah, absolutely. And so let's discuss General Electric a little bit. They've been struggling recently with profitability. What strategic actions would you take today if you were their CEO?
He's an interesting name because it's one of those names that up until the past few years, it was big enough that almost every investment manager owned at least some GE. We were the exception to that, and for many, many years thought GE was selling at too expensive a price. That they were a very good industrial business and they were an okay financial business. And the stock was selling at a multiple of like 30 times earnings when good industrial companies were at teens multiples and good financial service companies were barely at double-digit multiples. So we thought we could kind of recreate GE, the pieces of GE, much more cheaply than GE was selling. So we never owned any of it. And in the great financial crisis, that was really about the first time that GE's stock price got hit enough that you could no longer say you could buy a good industrial and a good financial company cheaper than the multiple GE was selling at. We were still a little suspicious of GE management back then. They were big owners of the Vivendi media assets. And as they were deciding to streamline a little bit and sold their media assets, we were invested on the other side of that with companies like Comcast. And when you heard the great efforts that GE went to make it look like the price they got was a very high price, even though the terms and conditions of the deal all benefited Comcast so much that, like, on a real basis, it knocked down the price a lot. We were very worried that GE had such a culture of focusing on reported earnings per share at the expense of cash flow that we stayed away for quite a few more years. And then it was with a changeover in management, we thought that the stock had finally gotten cheap enough when it was in the 20s that very good aerospace business, very good healthcare business, decent power business. They were exiting financial businesses that we thought they could get out of for better than book value. And we thought they were on a course, and everybody hated GE. It was kind of one of the more popular names if you were a diversified or conglomerate analyst to say the one name I hate is GE, and I don't want you to own that one. And so it was out of favor. It looked cheap, and that was and management that was starting to focus on cash flow. That's why we got interested. What we really missed was what a complete job GE management had done in the power business of pulling forward earnings that would normally be recognized over the next decade to kind of cover up declining reported earnings. So they were able to continue to report high EPS, but it was at the expense of the future of the power business. When we finally understood that was about the same time that GE was again changing the CEO, and they brought in Culp, who had been viewed as one of the best diversified company managers when he was at Danaher. And GE stock had fallen to about $6 a share. And we were looking at it saying, if you believe power is worthless and all they've got is aerospace and healthcare, and you only put multiples on those two businesses that are normal for other companies in those industries, even though we think there are reasons to believe they're better than average, you'd get a price, and then deduct the debt, you'd get a price much higher than it was selling in the market. So the fact that we didn't have to rely on the management that created this problem or the business that we so badly misunderstood made us stick with the company, even though our default normally is if we misanalyze something that badly, we don't want to then bet that we're going to be right on predicting the turnaround of the businesses we misunderstood. But aerospace and healthcare were performing as expected. And we had a CEO in now who truly understood that and was focused on maximizing long-term value. So even though the stock's up somewhat to $13 now, we still think the argument is accurate that if you believe their aerospace business is about as good an industrial business as there is, and we think they were starting to prove that right before COVID. In industrial businesses, you worry, kind of like with what I was saying about Apple, do you have to have the newest, coolest product each time you go through an upgrade cycle to continue your earnings stream? But what we liked about GE and what we've liked about other industrial businesses is when the majority of profits are coming from parts and services instead of new equipment sales, then the business becomes less cyclical, less dependent on new release cycles. And GE was definitely that model, with most of their profits coming from parts and services. And then travel went to zero for a year. And so maintenance on engines was way down. Certainly repair parts didn't need to be replaced at the same pace. And they had one of their first declines ever in that business. So we think it's going to take a couple years to prove that the aerospace business is as good a business as we believe it is. But we're believers that the economy comes back quickly, that travel comes back, both leisure and business travel. So we think we're within a couple year period of our view becoming consensus that GE Aerospace is an incredibly good business. And based on that, we think it's a reasonably short time frame till other investors come around to that same belief that GE is going to be able to earn something like $1.50 a share, and it'll sell at a premium multiple when it does that.
Yeah, absolutely. So should they spin off those businesses, do you think, the healthcare and the aviation?
We trust management to make that call. I think the market would like it. The market always likes spinoffs because the market tends to value pure plays higher, because you might have somebody who loves GE Aerospace but isn't a big fan of GE Healthcare. And right now, the only way to buy GE Aerospace is to buy both. But we think there are some reasons that there are some synergies in having the businesses together, including both being able to draw on GE's very strong library of intellectual property. But I'm very confident management will make the right long-term decision. If you are an activist investor and you wanted to maximize GE's stock price 6 months from now, I think it's pretty clear you'd split it up into pieces. You probably have a pure aerospace business, a pure healthcare business, and then kind of a legacy business of power and some of the financial liabilities. But it's much less clear if your goal is to maximize value 5 to 7 years from now, and that's our time frame, much less clear that you're going to gain anything by spinning off healthcare.
Yeah, absolutely. That makes a lot of sense. Thank you. And can you please discuss why you sold out of Fiat Chrysler and your thoughts on Stellantis?
We sold Fiat Chrysler after they decided. Let me back up. We thought Sergio Marchionne was one of the best executives, not just in the auto industry, but period. Great history of unlocking value. He came in, merged Chrysler into Fiat, paid almost nothing for Chrysler at the time of that merger. And with Chrysler, we thought that Fiat was getting two of the best brand names in the auto business in Jeep and Ram trucks. And the problem with Chrysler, the way it was set up, Jeep and Ram were very profitable, but they were committed to making consumer sedans a success. And in consumer cars, they were losing a lot, to the point that net income wasn't a very meaningful number, and the company's future was in jeopardy. Sergio was able to bring down the losses a lot on the car side of the business, while continuing to grow market share and grow profitability on the truck and SUV side. And we were valuing, the reason we owned it is we thought that the SUV and truck business would deserve a premium multiple to the rest of the auto industry. And I don't remember, the stock was trading at 11 or so. They were earning $3 or $4 a share. They were committed to return of capital. And our argument was that it should probably trade at more like 8 to 10 times earnings, and that would be more than double the stock price. They were also big believers that the industry needed to consolidate, and they wanted to consolidate with GM. They couldn't make that work. And they ended up kind of, not really through an auction process, but after pursuing each different company to see what they could put together, deciding that Renault was the best combination for them. French company, we were uncomfortable that inside of Renault that the Jeep and Ram brands were going to be as valuable as we thought they were. And frankly, uncomfortable with the idea that after such an extensive search for a partner, that was the best deal that they could broker. So this was all coming together about the same time as COVID hit last year. And as the market took down the price of Fiat from like 13 to 7, companies that were less cyclical, less levered, less concerned that COVID was going to hurt their business also fell 50%. So on an enterprise value basis, they fell much less than Fiat did. And it wasn't so much that we disliked the idea of owning Fiat at that price, but we needed to find money to buy these other things that were cheap. And because of the concerns we had, given they'd just been through a process to sell the company, and that the best deal they could come up with was Renault. And even though the stock was at 7, it wasn't like private equity was coming in offering to pay 6 times earnings. We thought we'd rather own something like Booking.com that had been cut in half, or Pinterest that had net cash on the balance sheet had been cut by 2/3, that we could kind of increase the safety in the portfolio at the same time we were increasing discount to enterprise value.
Yeah, absolutely. That's very helpful. Thank you for those explanations. And what are your thoughts on Citigroup's new CEO and the management, as well as their intentions to sell most of their division in Asia?
We like the old CEO at Citi. We like the new CEO. The reason we own this stock, the same as a lot of our other bank stocks, is that it's selling at basically tangible book value, single-digit PE on earnings that they should be able to get to within a couple of years. They don't need lots of top-line growth to make earnings per share grow better than the market. They're very comfortable with share repurchase. There's a decent dividend. And we think their commercial franchise, basically treasury services for large corporations that want to have one global bank, we think that's something that's unmatched in the industry and one of the best businesses in the banking industry. One of the exciting things about the new CEO coming in is that she's able to take a fresh look at everything. And Jane has already said they are reevaluating every business Citi is in with the intent of slimming Citi down to only the businesses it's competitively advantaged in. That's a little bit of a change in Citi's way of thinking, where no longer are they concerned about how big the bank is relative to other banks. They want to be in areas that they have strong competitive advantage where they can maximize ROE. And you start looking at the other businesses that they want to exit, and it's pretty easy to see that Citi is not the right long-term strategic owner of that business. That there are banks in Asia that are more logical long-term owners of Citi's banks in Asia than Citi is, because Citi was never going to be big enough to be competitively advantaged in broad-based retail banking in Asia. Yet other people who do have scale already will be very happy to pay a premium to book value to add on Citi's assets, because they'll immediately be able to put them into their lower cost structure. As we look at the other businesses where we don't think Citi is competitively advantaged, we think there are multiple logical buyers for all of those businesses, and that anything they exit, they should be able to get a premium to book value, which is a higher price than their company is being valued at today. So anything they can sell for $1.25, $1.50, use those proceeds to buy back stock at book value, and the company is going to have a significantly higher ROE, because what they slim down to is their best, most competitively advantaged businesses. If this story was in anything else other than banking, a new CEO comes into a business that's got one giant competitively advantaged business and is going to focus on slimming down to that business over the next few years, I think the market would be very, very excited about it. Because it's banking, it's greeted with kind of a shoulder shrug. And we think Citi is one of the best self-help stories within the banking industry. It's cheaper than a company like Bank America that we also own, but Bank America is already focused on the businesses that it's already competitively advantaged in. It's cheaper than JP Morgan, which we don't own, which is widely recognized as the best managed, highest ROE company in the industry. And because of that, we don't think we've got much of a point of difference with the market. We think Jamie Dimon's a great CEO, but everybody thinks he's a great CEO. This to us is more reminiscent of Brian Moynihan's early days at Bank America, where there was a wide range of opinion on his ability to succeed in the turnaround, his strength as a leader. And we were of the belief that he was one of the best managers in the banking industry. I think Lynch at Citi is that same person right now, where there's a skill set that makes us believe she'll be among the leaders in the industry 5 years from now. And as a value investor, we love that we don't have to pay for that today.
And for companies in sectors like banking or insurance, how can you get comfortable with the black box component of the investment, underlying complex financial assets, which may not be extensively detailed in the company's financial statements? So in other words, what helps you avoid investing in financial institutions that have situations like the Archegos implosion that affected Credit Suisse and Nomura?
Well, first off, I would say it's a misnomer to think that there aren't black box elements inside of almost every company you look at. The idea that you're going to be able to pick up the financial statements of any company and thoroughly understand all the details and every potential pothole that they could step in, I think significantly understates the risk outside of the financial sector. I think a mistake a lot of people made coming out of the great financial crisis was blaming the black box, if you will, for what went wrong in financial companies that they got wrong. And I mean, we got as much wrong in the financial crisis as anybody did. We owned companies like Bank America going into it. But if you had told me in 2008 that we were about to enter the biggest decline in real estate that the country had ever seen, especially residential real estate, the argument up until 2008 was a recession for residential real estate on a nationwide basis was that prices would kind of flatline for a couple of years and then they'd resume their upward march. If you had said a typical home might lose 20, 30% of its value, if we'd foreseen that environment, you knew the banks would be a disaster. The left-hand side of their balance sheet is almost entirely loans against real estate. And there aren't a lot of those loans where they have more than a 20% cushion. So to blame the problems in '08 on the black box, I think is wrong. With Credit Suisse, I think it's a little bit different. I mean, all of these companies are taking risks that are not well identified in the financial statements. I would argue that goes broader than financials, and I would say all companies are taking some level of risk that is not well cited in their financials. But that's why quality of management is so important. I think one of the mistakes we've made as a firm is I think we've been reasonably astute at identifying shortfalls of the management team, but have understated how big a negative effect they could have on the company while we were arguing for an upgrade in management quality. Now with Credit Suisse and the new management coming in, we're again excited about the outlook there because the guy coming in from Lloyd's has such a good track record on turnarounds. We've been invested with him previously. So we think that situation is well on the way to fixing itself. But I think one of the lessons you quickly learn in financials is because of the leverage on the balance sheet, small mistakes relative to assets become big mistakes relative to equity. And you have to have management that you trust that's making those decisions, as you do really with any company. I mean, I think one of the lessons we learn too many times is if you don't fully trust management, you shouldn't be invested with them. But it's not unique to financials.
Yeah, thank you. That way of thinking is very, very helpful. How would you advise new investors to learn to analyze the pharmaceutical sector? And as an example, can you detail your thinking for Regeneron?
Sure. I think the biggest thing to understand with the pharma industry is existing drugs are basically a fantastic business. Margins are very high. And the problem is that they've got a defined lifespan. And for most of the pharmaceutical industry, when something goes off patent, its profitability goes down very, very quickly to some relatively trivial number compared to what the company had been earning. So you almost have to analyze pharma like you would an oil company, where you've got a well that is going to produce for a certain number of years, and you want to be careful about just slapping a high PE on that. You really do have to go through the DCF model based on what you think annual profits will be and an end point. And then coupled with that, in the oil and gas business, you've got exploration. In the pharma industry, you've got R&D. So we try to separate out valuing how much has been spent on R&D that has not found its way yet into products that are far enough along in the pipeline that we've got a specific value assigned to them. And then for products that are already in the market, have an estimate of their life, what the curve is going to look like, and really do a drug by drug DCF. It's one of the few industries that you can't say this is a great company and it's selling at 8 times earnings. It must be incredibly cheap, because it might be 1 or 2 drugs that are producing that earnings stream today, and they could go off patent just a couple of years from now. So the PE can really give you a deceiving level of cheapness. So what we saw when we looked at Regeneron, initially it was one of the most unliked drug companies, or actually biotech, but we think of the two as pretty interchangeable. And it was quite disliked because it was selling at, I don't remember, 20 sometimes earnings, when you could buy a lot of the traditional pharma industry at half that PE. So one of the things we always do is look at pre-R&D multiples, because we figure if we like the management, it's going to mean money they're spending on R&D is a good venture cap-like investment. And if they didn't think they were going to get more than $1 for $1 of R&D spending, they wouldn't be making that expenditure. So where as a typical company, we might look at enterprise value relative to EBIT or EBITA. With a pharma company, we'd look at EBITA plus R&D. And Regeneron was spending about twice the percentage of its sales in R&D as its average competitor. And if we said, let's pretend that management decided to cut R&D down to industry average levels, what would the PE multiple look like? And suddenly you're looking at a company that was priced at a discount to traditional pharma, yet its drugs had longer patent lives than most of traditional pharma, and it seemed to have an R&D machine that made the likelihood of getting much more than $1 back for each $1 that went into R&D much higher than it was at other companies. I mean, a lot of other companies in the R&D or in the pharma industry are more bureaucratic. They're run by business people. They're run by lawyers. Regeneron's run by scientists, and they try to make it the most desirable end destination there is for leading scientists. And we think because of that, they've been able to put together an R&D machine that is creating $1.25 of value, say, out of each $1 they're putting into it. They've got management that is comfortable repurchasing stock when they think the stock is cheap. They are aggressive repurchasers today. They've got a management team that asked to have a cut in their cash compensation so that they could increase their amount of option compensation, and it's levered on how valuable they make Regeneron. I mean, one of the things that we're really focused on, we're not a deep value quant shop that's just looking for lowest PEs and price to books. We're very much on the qualitative side of, do we have a strong management team whose economic incentives are aligned with us as outside shareholders? And we're very confident that Regeneron's management team, if they want to maximize their personal compensation over the next decade, everything they would do to maximize their own outcomes is the same thing that you would do to maximize the outcome as an outside shareholder.
Yeah, that makes a lot of sense with those incentive plans, absolutely. And so what qualities, backgrounds, and experiences are you looking for interns who wants to intern at Harris Associates?
So I would say, for starters, we're generally in the business school, though we have broadened that out somewhat to get a more diverse set of resumes into our firm. And we've found that the quantitatively strong minds that we are looking for, that we have generally found in finance majors or accounting majors, that you can also find that in math majors or physics majors. And with a little bit of effort to try and convert those people to wanting to work in the investment side, that we can attract a more interesting pool of candidates. But generally, we want people that are passionate about investing, that love math, they love the challenges of this game of investing, where you're trying to outthink other people that are also smart, that are also willing to spend the majority of their time on this challenge of creating great long-term investment results, that you can do it better than they do. We need people that are disciplined. I think there are people of all different walks that can become successful investors, growth investors, value investors, commodity investors. But one thing that you see that's consistent across all of them is a discipline of sticking to their style. And this business plays tricks with your head when you're out of favor. And the worst thing you can do, since styles tend to cycle in and out of favor, it's like the most intense pressure on you to give up on your style is when it's most important that you maintain it. So you need people that are disciplined, that are comfortable with a contrarian point of view, almost taking pride in a contrarian point of view. So those are some of the skills we're looking for in interns. When we're hiring experienced people, we want a strong commitment to a value approach, to already be deep-seated in that person. We don't want to have to teach them value investing. So generally we'd be looking at, say, a 5-year experience, either with somebody that does value investing or that wasn't a value investor, but this individual was frustrated because there wasn't mind meld with the company they were working for. So I think one of the things that we see in college students is a lot of times the finance students don't want to take accounting. And I think it's really important. I knew when I was in high school that I wanted to be in this industry. And to me, learning accounting was like learning a second language. To say you want to go into investing and not really care much about accounting would be like to say I want to live the rest of my life in South America, but I don't want to bother learning Spanish. It just doesn't make any sense. And so accounting background is something we're looking for. Our interns, we're generally hiring them after their second year, and then inviting some of them back after their third year. So if we're trying to hire them after year 2, we're interviewing them early in year 2, and they haven't had a lot of business classes by then. They haven't had much in the way of accounting. It'd be great to see Excel skills. I would say probably your first 5 years out of college, if you're at an investment firm, it's going to be very heavily weighted to model building. And that's whether you're asset management, investment banking, really any of the areas. So I would say if your school isn't offering a good program in Excel by the time you're a sophomore, do that on your own time and make sure it's a skill that you're proud of. Because anybody that you're looking to get an internship, you're going to rise in the group of resumes that they have if you've got strong Excel skills. So that's part of what we're looking for.
Yeah, absolutely. Thank you so much for that advice. And I think for concluding question, what do you think was the most influential event in your career?
It's hard to pick one event, so I'm not going to answer it completely directly. I'd say the most important thing during my career was I took a job out of school at an insurance company. And back when I went to school, most of the MBA programs were immediately after college. So I went to school for 5 years, had an MBA or a master's in finance. It was master's of science, not MBA. So I had that at 23 years old and was starting a career. And so it wasn't like back then, if you thought you were in a mismatch with your firm, maybe you take that as a chance to reboot, you go to business school and then kind of start over. But I'd gone to an insurance company and didn't have a match of investment styles. Worked for them for 2 years, and I would say the most important event for me was joining Harris Associates after 2 years, because I was joining a firm that thought about value investing, thought about investing as value investing the same way I did. So that was hugely important. I think one of the most important things in terms of career progress was when we started the Oakmark family of funds back in 1991. Prior to that, as I had said earlier, we were a high net worth business. And that was a business where everything you do marketing is one-on-one. You go to charitable events to meet wealthy individuals and, get to know them, have them get to know you, so that you're a trusted confidant by the time they're making a decision of hiring an investment manager. And like someone like me, that was never going to be how I was comfortable spending my time. So the founders here kind of assumed my generation was going to be a washout on marketing, because none of us wanted to structure our lives that way. And one of the big realizations was, as we started our mutual fund family, that marketing, instead of being one-to-one, was one-to-many. And you could write something that thousands of people would read. You could do an interview that thousands of people would see. And that type of marketing was much more suited to my generation at Harris Associates. And I think that was something that really helped our careers blossom. In terms of progression from being an analyst to a portfolio manager, the best stock by far, most important to my career that I worked on, was Liberty Media. It was a spinoff from Telecommunications Inc. back in the very early 90s. And it was the messiest prospectus I had ever looked at, 700 pages long, a complete hodgepodge of assets. And it was very easy for people to come up with excuses as to why they didn't want to bother looking at it. We made Liberty Media our largest holding, and in the ensuing 5 years made about 20 times our capital on it. As management, it was a levered investment in a bunch of unrelated pieces at a large discount. As management sold off pieces, bought back stock, the value became more obvious and the stock performed incredibly well. But it was through that process that I learned how important it was to not shun an investment because it was complicated. And I was at a meeting once with John Malone, who was the CEO that engineered this split, and somebody was complaining about why didn't he make it more obvious how attractive Liberty was. And John's answer was, every piece of information you needed to see how attractive this was public. And all I can tell you is, next time we come out with a prospectus, read it. And I think that's a really important lesson to people that are always looking for shortcuts on the investment side, is how can I figure out in half an hour if this is a name I should be interested in or not? Or, can I go on Reddit and read somebody else's analysis and in 15 minutes have an opinion on this company? There's no shortcut to doing your own work, to doing the reading, coming to your own conclusions, and then having the confidence to believe in yourself even when not many people are agreeing with you. And that lesson has stuck with me for what's probably almost 30 years since then. And it's helped me elevate the level of our analysts' work, certainly elevate the level of my own work, and just a constant reminder to what the costs are of cutting corners. So it's not one event, but hopefully all three of those are somewhat useful examples.
Yeah, that's really great. Thank you so much. And thank you so much for joining us today. We really, really appreciate you taking the time out of your busy schedule.
Happy to have the chance to do it. And thanks for asking me. I hope everybody finds this useful.
I'm sure that they will. Thank you so much.
Okay,
Have a great day.
take care. Bye-bye.